Good afternoon, everybody. Thank you for joining us for this program on international tax legislation and practical analysis, where the panelists will be talking about pending international tax provisions. I am Michelle Weiss. I am the chair of the tax section, and I'm welcoming you here today. I will briefly introduce the speakers, and I also, before we get started, want to thank our section sponsor, the firm of Hockman, Salkin, I think Tasha and Perez. They have been a perennial sponsor of the section, and we very much appreciate their support. So our panelists today all have many years, decades of experience in international tax planning, international tax provisions for all different types of clients, small businesses, large businesses, and individuals, high net worth individuals. Our panelists include Bill Norman, who is a partner at Norman & Zach. He's also a certified specialist in taxation law. I also want to welcome Stephen Mihaly, who is at KFB Rice. He also is a certified California State Bar certified specialist in tax law, and he's also a California State Bar specialist in estate planning, probate, and trusts. And I also want to introduce Tom Giordano, who is at Karlin and Peebles, where he focuses on high net worth individuals and closely held businesses who have international tax issues. And with that, take it away.
Thank you, Michelle. Let's just take a quick look at the agenda. I'm not going to read all these items, about a dozen items. We're going to start with a little background of the international tax legislation, of the tax legislation in general, the federal legislation, and its status as at least last night. And then we're going to go through some selected provisions, which we think are some of the more important provisions. Some will not apply to smaller, if you will, or mid-sized companies, but we included them because they're have some important policy implications and revenue implications. So we'll also at the end there on the next slide, we'll talk a little bit about IRS enforcement enhancements and proposals for additional funding, and then end up with some discussion of what the impact of these provisions, if enacted, would be on cross-border private client planning. So next, let's take a look at where we are in the legislation. All of this kind of began really after the enactment of the Tax Cuts and Jobs Act in 2017. I mean, that act was criticized in a number of quarters. And as you know, most of you know, it passed only with Republican votes and of course, a Republican president who signed it. But this legislation, you can look at it as beginning with the Green Book, which is the Department of Treasury's tax proposals as part of the budget in May of this year. Then we had Senator Wyden, who's the chair of the Senate Finance Committee, who issued a draft legislative language in August of this year. He had earlier a kind of outline of his proposals. Then the House of Representatives actually passed out the Build Back Better Act in November 19th. And then what was it, last Saturday, Senate Finance Committee released some legislative language as well. Their version of the Build Back Better Act, which we have is December 11. And then what you don't have on this slide is the president is meeting with Senator Joe Manchin to find out what he wants. And he seems to be at this point, the most important player, although the Democrats would need all the rest of their 49 senators to approve. And of course, if it goes back to the House with a different bill out of the Senate, it's got to go through the same process in the House. So that's kind of where we are. In terms of projections as to what will happen. I think earlier in the month, the smart money was saying it's going to pass before the end of the year, maybe before Christmas. Now it's getting maybe 50-50. I didn't check the Las Vegas odds on this, but it's even possible it could be pushed into next year or maybe just left to languish for a while. But you have to be aware of it because it does have potential importance to many clients that are in international operations. Okay, let's start off with the first topic here, which are the GILTI changes. We're going to assume some basic knowledge of international tax and in particular the Tax Cuts and Jobs Act provisions, not the details of it, but just kind of know what these provisions are. The first change that's and I'm talking really about the House version. I didn't see that much, at least in the changes in the provisions I'm talking about, that many changes, if at all, in the Senate version, although I was able to run a line-by-line check of that, if you will, red line of it. First thing is the 250 deduction, which reduces the GILTI inclusion, which is basically the current earnings of a controlled foreign corporation owned by a U.S. shareholder. And we're talking here about a domestic corporation. Would be reduced from 50% to 28.5. That changes the effective rate, if we assume a corporate rate of 21, from 10.5 to just a hair over 15%. For some reason, it doesn't exactly round out. There's going to be a repeal of the taxable income limitation, that is the deduction for GILTI, and the other part of the 250 deduction, which is FDII, the foreign derived intangible income provision, which we'll talk about shortly. That's not going to be limited by taxable income in a given year, so it can be carried forward like an NOL. You can have in your controlled foreign corporations losses. Under current legislation, those are essentially lost. But the proposed legislation, the House version would, and the Senate would allow a carry forward of that. It's going to be subject to a 382 limitation if you have a change of ownership, similar to what you have when you have an NOL. The percentage return on QBI, which is the amount that reduces the GILTI inclusion and results in a tax-free dividend, a dividend received deduction by a U.S. shareholder, it's a domestic corporation. That's going to be reduced to from 10% to 5%. And then we're going to have which is the kind of most ugly part of this proposal, is the GILTI inclusion is going to be determined country by country with respect to each so-called CFC taxable unit, which is a new defined term. So the complexity of the GILTI inclusion is going to be determining it's going to be considerably increased. Going to the next slide here, we have some changes relating essentially to the foreign tax credit. That's it's made clear here that the 250 deduction is a deduction against the GILTI inclusion, but the other deductions against the GILTI inclusion amount are going to be only ones that are directly related expenses. So that takes care of a anomaly in the Tax Cuts and Jobs Act, where there was an indication that the effective GILTI rate was going to be 10.5, where in fact it was really much higher because of allocations of deduction. So that's been largely taken care of. The foreign tax credit haircut, that is reduction in the amount of the foreign tax credit can be taken, has been reduced from 20 to 5. So that's a good provision from the taxpayer viewpoint. Foreign tax credit for GILTI carry forward is now allowed for 5 years until 2030, and then it reverts to whatever the rule is generally for carry forwards for foreign tax credits. However, when you have a distribution of GILTI and there's withholding tax, that's still going to be subject to a 20% reduction in terms of the amount of the foreign tax that can be credited. In US possessions, there's some differences in the QBI return. It stays at 10%. And there's going to be no haircut for foreign withholding taxes. Next slide. Defines what a CFC tested unit is. It's basically the CFC itself, any pass-throughs held by the CFC, and foreign branches. And so the calculations are done on the basis of these three possibilities, as opposed to just at the CFC level and then aggregated. The next slide talks about what's a tax resident. Nothing surprising here, except if there's an entity that's organized in a country that doesn't have any income tax, then it's treated as if it does impose an income tax for purposes of determining whether that's a separate unit, if you will, taxable unit. I put together in the next few slides, we look at the example, just to see what does it mean that you have this guilty calculation done on a country by country basis. So I put together a little example here. The U.S. shareholder, it's a domestic corporation, has two CFCs, one's in country A and one's in country B. That tested income in each one is 100. Only country A imposes a foreign income tax. That's on CFC 1. And then I assumed a little QBI of just $2 in this little example. I'm not going to take you through the math, which is in the next slide, but what I did is I did one calculation assuming the existing law of a single guilty basket remained, but I used the new deduction amount, the 28.5%, and I put the new haircut in, and then I did the same thing in the next two slides, doing it separately country by country, using the facts that we have there, and then did the solutions. This is for country B here, which is the one that has no tax. And the summary, well, when you have the foreign tax at 18%, basically 18 out of, or not 18%, 18 out of 100, but 18 out of 200, and the other country doesn't impose any tax at all, you get no difference whether it's per country or as a single basket. I didn't put it in the materials, but I did another example where I had the foreign tax rate on country A 26%, which is the OECD average, and the other country 0. When you do that, when the foreign country imposes a tax higher than the US tax in a given basket, if you will, per country per unit, per CFC unit basket, you end up with a higher tax, as you would imagine, under the per country calculation. You can do another one where both units are subject to taxes higher than the US rate, and I didn't do that example to see what happened. I suppose the kind of takeaway from all that is do your calculations and see what the results are, but it looks like you've got to have at least one of the foreign tax rates higher than the US rate for the country by country calculation to mean anything. Okay, next, just very briefly, the FDII calculations. The president proposal in the Green Book was to throw out FDII completely and replace it with an R&D incentive or credit of some sort. Congress has not, both the Senate and the House have not really picked up on that, but they have reduced the benefit of FDII, the deduction under 250, down to 24.8%. I think it was 37% existing law. That changes the effective rate, moving it from 13.125 up to 15.8. And it's very close then to what the guilty theoretical rate is of roughly 15%. So the two are in much closer parity than they were under the, or they are under the existing legislation. The deduction for Cubine or the FDII provisions is going to not remain at 10%, not 5%. There's some items taken out of what's deduction eligible income, which is the kind of beginning point to determine how much FDII is available. This legislation is effective 12/31/22. I think they didn't mention the effective date for guilty, which is also 12 years beginning after 12/31/22. So we end up with a year kind of waiting for regulations and trying to figure out what this means. Okay, with that, let me turn it to Tom.
All right, thanks, Bill. So very briefly, I just want to kind of summarize the changes that have been made to the BEAT, which is the base erosion anti-abuse tax. We're not going to get too deep into it because it only applies to a very small set of taxpayers, which are so-called applicable taxpayers. And this slide shows you a summary of the current law. And those applicable taxpayers generally have gross receipts of over 500 million on average over the last 3 years. And again, there's some technical nuances to that, but as you can see, it's very large taxpayers that are the subject of this tax. And the way the tax works is essentially these large multinationals determine what their tax would be under normal principles, with some small exceptions not worth noting. And then it's almost like an alternative minimum tax. Then they calculate their so-called base erosion minimum tax amount. And to the extent it's greater, then there's a 10% tax on it. And that modified taxable income number is derived by adding back a number of related party payments, such as royalty, interest, things of that nature. It's all added back to the taxable income amount. And like its name suggests, the aim of it is to prevent sort of deductible payments going to low tax jurisdictions, and thereby reducing the base to which the usual corporate tax is applied for U.S. principles. So that's it. What the proposed changes to this provision are largely rate driven. So the current amount is 10% of the modified taxable income, and then it goes up to 12.5% after 2025. What both the House and Senate were aligned on this. They proposed increases of after 2022, it goes to 12.5%, then to 15% in 2024, and then 18% for 2025 and thereafter. So just revenue raisers and higher rate amounts. I think there were some small technical changes, but for the most part, the substance were the rate changes. So that's,
I suppose the big one is they took out the 3%.
yeah, for the purpose of measuring who the applicable taxpayer is.
Yeah,
on the base erosion percentage, correct?
I guess I think the number of taxpayers were trying to they were over the 500 million, but they were using the 3% base erosion percentage as a way to avoid being applicable, having BEAT applied to them.
Yeah, so it's a broader group to which it applies, right?
Yeah.
So that's the BEAT. Again, we're not trying to get too deep into the weeds there. It's a very targeted tax and applies to only a small set of taxpayers, and there's a lot to discuss. So that's sort of the 10,000 view summary. So the next provision that I'm going to discuss is the limitation on the interest deduction, which is pretty interesting, and it's sort of kind of a harken back to the old earning stripping rules that were removed in 2017. I mean, it doesn't operate the same, but it's a similar sort of idea. And it's funny, I guess it's actually probably pretty typical these days, but the actual taxing provision is just really a string of defined terms that you then have to kind of cross-reference and make your way through to figure out who it applies to. But essentially, what you need to know to if it applies is you need to be a specified domestic corporation, and you need to be a member of an international financial reporting group. So first we look at, okay, we've got our domestic corp, and it needs to have interest paid or accrued over its interest income. So it applies to all taxpayers other than those that are highlighted. So if you have 12 million net interest expense after deducting interest income of 12 million or less, you're not subject to these limitation rules. If you're a small business under the 163J, the 2017 revised 163J rules, the gross receipts less than 25 million, you won't be subject to these. S corps are not subject to these. But in terms of measuring them, you will aggregate sort of related corporations. So you can't sort of split up the corporations to determine when you're measuring kind of these limitation or thresholds. And to the extent you have a foreign corporation that's earning effectively connected income or engaged in a U.S. trade or business, that for the ECI, it will be treated as a domestic corp. And I'm going to show you what an international financial reporting group is later. I did some diagrams, which makes it a bit more helpful. And then essentially what the limitation is, you have to determine all of these various calculations. So there's an allowable percentage, reported net interest expense, allocable share of reported net interest expense. All of these terms need to be determined, and I think it's easier to kind of go to my slide 21. But first, again, we went through what a specified domestic corporation is to apply. It also needs to be a member of an international financial reporting group. And essentially that's two or more entities, one of which is a US corp. So that's over on the left, you've got a foreign corp, a US corp, that is an international financial reporting group. Or it can apply to all foreign corps if one of them is engaged in a US trade or business. So that's how you determine your international financial reporting group. So if you had a bunch of foreign corps that were not engaged in a US trade or business, then obviously this wouldn't apply. Likewise, if you had a bunch of domestic corporations with no foreign corp, this would not apply. So you have to both meet the thresholds I set out in the first slide, specified foreign corp, and then also that specified foreign corp needs to be a member of this international financial reporting group. And this term, international financial reporting group, was used more frequently than just these interest limitation rules in both the House and Senate versions, specifically with respect to the corporate AMT, which is, if you've been paying any attention, is sort of the book income tax, as they're calling it. So it may become a more important term throughout the code, depending on what ultimately passes. But to sort of understand the limitation, I think it's easier to kind of look at it in terms of formulas. You're essentially, one, you need to determine your applicable percentage, your quote unquote applicable percentage. And I've showed you what that is here. It's essentially, you're determining the groups you're determining the US, the taxpayer that we're measuring, that corp's allocable share of the group's net interest expense. And there's going to be, we'll get to how you make the determination of allocable share over the corp's reported net interest expense. So that's going to give you your allocable percentage. But those are full of their own defined terms. So you move down. So how do you determine the net interest expense of the group? Well, you do that by looking at the group's financial statements and determining its consolidated interest expense over its interest income. So whatever that net figure is on their financial statement, that's the reported amount. And you need that amount to then determine the allocable that will factor into the applicable percentage. So you get that amount, and then you move down to the net interest expense of the specified domestic corp, and that's the measured taxpayer's net interest expense over its net income as reported in its books and records. So now you have the net interest expense of the domestic corp and then the net interest expense of the reporting group. And now you can find the allocable share, right? So that's basically the corporation, the measured corporation's EBITDA over the group's EBITDA, right? So you're looking at sort of you're essentially looking at the ratio of the corporation's share of the overall EBITDA. And so you get your allocable share. You can then now use that amount to determine your applicable percentage up on number one, which is, okay, let's assume, the corp's EBITDA over the entire EBITDA is 33%, and you do 33% of the net interest expense determined in number two over the determination in number three. And that gives you your applicable percentage. Now what you do is then you go down to the limitation, which is number five, and you take the interest expense of the domestic corps minus the interest income, and this is reported, not books and records, but reported amount. You multiply that by 110%, and then you multiply it again by number one, and that will give you your limitation amount. So a lot of calculations, but if you kind of go through both the group's financial statements and the domestic corps and kind of do it a bit methodically, like I've laid out here, you'll be able to come up to your limitation. Now, what the Senate bill has done, all of that was the House's version, and the Senate largely duplicated the House, but the Senate allows a taxpayer to make an election to use the adjusted asset basis instead of the EBITDA. So when you're calculating number four, you can use asset basis instead of EBITDA, and most comments have been that that's taxpayer friendly, allowing, generally reducing the limitation. So there's some more slides in here that Bill prepared from a prior program that I left in because I think they're very helpful. It's kind of just a different way of going through what I just went through. And he also has an example here, which kind of shows the calculations in practice. Because we're somewhat limited on time, I'm not going to go through these numbers, but you can refer back to them, and I think it gives a little bit more clarity to what is a pretty complicated code provision, and who knows what the regs would look like under this. But again, it is a limitation. It does generally apply only to larger taxpayers with those really large dollar interest expense and gross receipts tests, but they're certainly a broader category of taxpayer than the beat that we were referring to. And so it's worth knowing because definitely many of us may have clients that fall within this, even if we're not sort of in the beat world.
I guess one thing is both this new 163N and the existing 163J they both apply, and it's the more limit that becomes the actual limitation on the interest deduction.
Yeah, you still have to go through the 163J rules and then the 163N rules, N as in Nancy, and then there's some coordination provisions. But yeah, it's not going to be fun year end for a lot of these clients. So with that, I'm going to turn it over to Steve, who's going to go through some changes to the portfolio interest exemption.
Very good, Tom. Yes, there's one change to the portfolio interest exemption. It basically did away with a way to game the rule, which prevents avoiding the 30% withholding tax. The rule was if you owned if you were a related shareholder, a U.S. foreign shareholder of a U.S. corporation, and you owned 10% or more of the stock of that U.S. corporation, you would not qualify for the exemption from the 30% withholding tax on portfolio debt, the portfolio debt being registered debt. But that rule in 871 H3B apparently only applied if the foreign shareholder owned 10% or more of the voting of all of the shares of the U.S. corporation and not the value. So taxpayers were kind of gaming that rule, and to put a stop to that, they've enacted a change here which requires, which applies the H7183B rule to foreign shareholders that own either 10% or more of the vote of all the shares of the U.S. corporation or of the value of the U.S. corporation.
I
Moving on to,
guess we were talking about whether there's any workaround on this. The attribution rules make this very hard to, if impossible, to beat, but use that term. But you could have a loan to an individual shareholder who then invests, the proceeds of a loan. And so
right.
no restriction on loans to related individuals.
Or you have a very close non-related party who you trust to be an intermediary. Or that's you have to worry about the conduit rules.
Like with father son, father is still in Hong Kong or Taiwan, and son is in the U.S. So you can make a loan to the son who then invests in the corporation, the S corporation.
Right, and in this day and age where interest rates are so low, a nice portfolio of debt paying 8% looks pretty good if there's no 30% withholding tax. Moving on to the main pièce de résistance of the legislation is the changes in the foreign tax credit, of which there are numerous changes. Many are minor and so technical it's not worth spending too much time. We will focus on the main changes to the foreign tax credit regime. And so what they've done is they have eliminated the branch category or basket of the determining foreign tax credits. In other words, there were 4 branches. There is 4 branches in the current law. One is for non-passive guilty type income. One is for foreign branch income, which they're doing away with if this is passed. One is for passive category income, and the other is for general limitation category income. And instead, they're going to only have 3, but they're going to now, as Bill mentioned previously, and let's talk about the guilty regime, apply the foreign tax credit limitation on a country-by-country basis. And this, the purpose of this is to eliminate largely the blending of high taxed country income in the same category with low taxed income from another, in the same category from another country. So it is a restriction on the ability to take foreign tax credits, in essence. The country-by-country methodology will be applied to, quote, taxable units, which I believe Bill also referred to in his prior work. And taxable units are essentially U.S. taxpayers, CFCs, pass-through entities of U.S. shareholders or CFCs that are tax residents of the foreign country, and branches of a U.S. taxpayer or CFC that have a taxable presence in the foreign country. So I think you already can see how complicated this is starting to get before we even get into it. I will try to give you a couple brief examples as we go along, just to give you a sense of the gist of the new regime. But I wanted to cover the main bullet points first. So the changes are all going into effect starting in 2023, because they will need at least a year, probably more, to come out with regulations, which the legislation grants Treasury to issue, because there will be a number of issues that need to be dealt with in adopting this new methodology, such as what expenses and how will they be assigned, such as deductions and foreign expense taxes to what taxable unit. There'll need to be coordination rules because some entities may be residents in more than one country. And the application of the rules calculating foreign tax credit for hybrids and payments between disregarded entities, which is enormously complicated. So a lot of this, the details are going to have to, we'll have to wait to see what they come out with the regulations. In fact, the current regulations are quite numerous and not always absolutely consistent. So all of that will need to be sorted out. And of course, all of this extra complication will lead to increased compliance burdens for your clients, significant increase in filing Form 1118s, most likely for each basket of income, for each taxable unit, for each country.
They're supposed to be foreign tax credit regulations issued before the end of the year. I think those mainly will deal with what's a creditable tax, dealing with digital services taxes and those kinds of regimes where there's no nexus, if you will, to the taxpayer that's subject to the tax. But anyway, we're going to have and we'll have rules that apply, you know, between 2018 and the effective date here of 2023, and then we're going to have new rules after that. So we'll have a lifetime of foreign tax regulations.
Large, a lot of learning to be done in the next year.
And transactions will be in here too, because you lose a basket and you got this per country.
Right. Just to give try to give a simple example. If you have a U.S. parent that has a CFC in country X and another CFC in country Y, and the U.S. parent also has a disregarded entity in country X, and the U.S. parent is getting subpart F general limitation income from CFC 1 and CFC 2 in the different countries, and let's say is getting royalty income from the disregarded entity. If they're all in the same general limitation category, income category, I'm sorry, then they are combined, but only for country by country. So you would end up combining the subpart income coming from CFC 1 in country X with the royalty income, that's general limitation income, coming from the disregarded entity in country X. But the subpart of income coming from CFC 2 in country Y will be subject to a separate limitation, because now we're doing it country by country. You cannot combine them as you can under this current rule, even though they're in different countries, the source of income. So that would be just a very simplistic. And of course, if one source is high tax and one is low tax, currently you can blend them, but going forward, you won't be able to blend the income and rates. Moving on to the next page. Oh, you're there already. Okay. This also is a little bit of covering what Bill was mentioning in GILTI, although this deals specifically with the foreign tax credit regime. So as I mentioned, GILTI is one of the foreign tax credit limitation categories, and they're changing the law so that the amount of deductions that are allocated against the GILTI included income will be less than under current law. And so this will result in the effectively the U.S. tax rate will be closer to, well, if the U.S. tax rate can be equivalent to what the foreign tax rate is, which Bill mentioned under the GILTI regime, amounts to 15.8%, then there will be no wasting, let's say, or of the US foreign tax credit. We want to end up with unused foreign tax credit. So this is kind of trying to match or get closer to what is essentially 15.8% tax, foreign tax, tax on guilty income. Another thing they've done is under current law, you can carry back excess foreign tax credits 1 year and forward 10 years, category by category. But under the new rule, they are going to eliminate the carryback, the 1 year carryback for all the categories. But for the guilty category, which does not have, under current law, you cannot carry forward, unlike the other categories, any excess foreign tax credits. So they're going to now allow you to carry forward the foreign tax credit, excess foreign tax credits in the guilty category for 5 years, which is a benefit, although you lose the carryback.
Actually, I think that goes to 2030, if you will, and then that limitation comes off. I mean,
okay,
when we get to 2030, we'll probably have 2 more, tax changes. So
right. I suppose that's a revenue issue. Then there is also under current law, if you have net CFC excess, if your CFCs have net losses that exceed your income, those cannot be carried forward under current law, net excess losses. But under the new law, they will allow you to carry over to the future years net excess CFC losses. But you won't be able to carry back any excess losses. So if you had in year 1, 100 of, let's say, guilty included in your income, and in year 2, you have 150 of losses, you cannot take those losses to carry back to reduce your guilty income to get a refund. You can only carry them forward. But it's better than nothing, which is what current law is. Let's see, I said I was going to mention a couple other examples. Let me see if well, I did mention one actually, yeah. So we can go into great detail about the foreign tax credit rules. They tweaked a number of other rules expanding the amount of overall foreign domestic losses that can be taken into account. So the calculations of the foreign tax credit are going to be, you're going to need completely new software, and it's going to take there's going to be a lot of revisions just in the way it's calculated, besides these major ones.
just a comment on that. You'll still have all of these the baskets minus the foreign branch basket, and then redoing that tested by tested unit, which then gets aggregated by country, and then you'll be doing those annually. So you're going to have if you don't distribute everything currently, so you're going to have quite a complex system of multiple categories per country, and then within that you've got I think it's up to 10 categories of types of income. So it's going to be quite a big
for taxpayers with a lot of entities in different countries, in multiple countries. It is going to seemingly get exponentially more complicated.
Okay.
If you're only in one country, perhaps not so.
Yeah. I was going to say on the PTIP, which is the previously taxed income, you can have up to 10 categories.
Right. I think they've been trying to reduce those categories.
And that's done annually. So you've got these 10 categories, four baskets every year. And then
right. So there's going to be a lot more work for anybody in this field.
Yeah.
Accountants, number crunching, all that. Okay, next slide. Yeah, so now I'm going to discuss the surcharge, which while you may think has nothing to do with international, it has some implications, which I'll get to. So as you probably all, well, maybe not all, but the only really significant income tax increase is a surcharge on high income individuals and, well, actually trusts and estates, which is the most significant thing, issue, which I'll get to in a moment. So for individuals and married persons who earn more than 10 million modified adjusted gross income, there's a 5% increase in the rate. So note that it's the same threshold whether you're single or married, so there's a marriage penalty. And there is an additional 3% if you, with respect to your income over 25 million. But in the case of trusts and estates, that threshold is only 200,000 for the 5% surcharge and 500,000 for the additional 3% surcharge. So it behooves clients with trusts and estates to make distributions to individual beneficiaries, because the beneficiaries have a $10 million threshold, right? But trusts and estates only have 200,000. Also, often partnerships only distribute enough to cover the highest tax amount. Well, all of those calculations will need to be adjusted because could be additional 5% or even 8%. So partnership agreements may need to be revised to take the surcharge into consideration. For non-resident aliens, the surcharge only applies to effectively connected income of the U.S. trade or business. For U.S. citizens or residents living abroad, the threshold is reduced by the amount of your 6911 exclusion. For purposes of determining the foreign tax credit and also alternative minimum tax, the surcharges are taken into consideration. For PFIC purposes, as you know, the QEF amount and other charges are determined the highest tax rates. And so the surcharges will be added to, will be part of that calculation of the highest tax rate. Interesting, a U.S. shareholder of a CFC who makes a Section 962 election, the surcharge is not taken into consideration for purposes of that calculation. And the surcharges come into effect beginning next year.
I mean, the reason the 962 is because you're picking, the income is being taxed at at least the inclusion at a corporate rate. If there's
at a corporate rate, right, at a domestic corporate rate, right.
Go back to the individual rate.
So for the foreign tax credit, you said they're taken into consideration. Does that mean they are they can be offset by a foreign tax?
I believe that's what it means. It's the,
Okay, because yeah, I mean the ACA, the 3.8%, because that was put in Chapter 2, it wasn't a credible tax, and I think the tax.
right. Well, that's what I read, that it.
Yeah. Okay, so that's great. That's good.
Yeah,
I was worried there'd be a lot of times when they're dealing with these surcharges, they're not deducted, or they're not, you know, they're top line and
right,
not subject to deductions or credits.
Okay, and let's see, shall we maybe Bruce, I mean, so Bill, do you want to take the next page, or shall I jump to page 30?
Yeah, this is a summary of headline and effective rates. I think it's important for kind of getting a kind of start on planning. That is, we'll talk about it in a minute, from a outbound viewpoint principally, although the beat of course applies to inbound, but the corporate rate remains at 21%, the US domestic rate. The GILTI rate moves down to a 15% effective rate. I get a different number than Steve had. The FDII rate ends up with a 15.8% rate. So if you compare, for instance, doing activities overseas where the income is going to be picked up at the domestic rate at 15, or you do it domestically and it qualifies for the FDII deduction, you have a 15.8% rate. The difference is very small, and so unlikely to motivate much movement overseas to get that 0.8% difference in tax rates. Now, the GILTI rate may be understated in the sense if you have, or the FDII rate, because you may have state income taxes that would apply to the FDII income, because that's domestic source income. GILTI would depend on your state system, whether you have combined reporting or water's edge election. So that gap between FDII and GILTI, the 0.8%, could be much larger than indicated there. I'll leave the BEAT implications alone. We've got the corporate book AMT, which we haven't talked about in detail because it applies to so few corporations. They're basically publicly traded, and we'll get to the thresholds of that in a subsequent slide. But that's a 15%. It's again a kind of minimum tax, if you will. I guess the interesting part of it is it's based upon financial statement income with a lot of adjustments. So I suspect with lobbying and some planning and some pressure on the auditors, this AMT will kind of shrink, if you will. That is the difference between tax and book, if you will gradually erode. But it's an interesting concept. It's using financial statement information that we already talked, Tom already talked about with respect to the limitation on interest deduction. So
if you notice, if you guys have been paying attention to the OECD Pillar 2, all of these 15% I don't think is coincidental. It sort of puts the US in line with meeting the sort of global 15% minimum rate that has at least been agreed to in framework, and the US has signed on to.
Yeah, that's kind of the 800-pound gorilla in the room, which we didn't talk about, which is
right.
Some of these rules, especially the GILTI rates and this corporate AMT, and parts of BEAT too, are based upon what happens with the agreement among, I guess it's up to almost 140 countries.
Yep.
15% minimum rate, but as Tom mentioned, it's based upon book. There's a lot of differences among accountants, and there'll be a difference certainly between tax and book. All right,
Can you go to the next slide? Yeah, so Bill just mentioned some of the changes in tax rates, but the individual tax rates for ordinary income remains at 37%. Long-term capital gains remains at 20% also. But there is a major change to the net investment income tax, the 3.8% tax, and it is quite substantial. In fact, it is, I think, the number 2 revenue raiser in the bill, to over 250 billion over 10 years. And the main change there is that currently it only applies to passive activities. It does not apply to income or gains from or sale of active trade or businesses where the taxpayer is materially participating. So under the new rule, which incidentally goes into effect January 1st, which means if anybody is doing a sale, they should close it before the end of the year to avoid the new tax or expansion of the tax, better to say. So under current law, the tax applies well, first of all, it applies to modified adjusted gross income less a threshold, and the current threshold is 250,000 for a married person and 200,000, I believe, for individual, and that's retained. But for a trust in the state, the threshold is only 13,050. So again, it behooves trusts to distribute their net investment income to individuals, and also to maybe try to split the income or gains among various trusts. Although there is section 643F, which one has to be concerned about, where IRS could aggregate the trust if they're too similar. Insofar as how does this apply in the international tax field? Well, net investment income includes GILTI inclusions, CFC subpart F income, and PFIC-QUEF inclusions. So that will, one has to take that into consideration as well. There is a phase-in threshold under the new rule at 500,000 for joint returns and 400,000 for single individuals. And basically, if your modified adjusted gross income exceeds those thresholds, let's say you have 540,000 of net investment income minus the 500,000 threshold. If your joint return, you have 50,000 excess, and then they divide it by 100,000 denominator. So they are going to increase the tax by 50% using this new methodology. So it doesn't take much excess net investment income to have 100% increase in the tax. So the only exception, so now basically everything is going to be subject to net investment income. The only exception really is for income that's subject to FICA or SICA tax, i.e. self-employment income or wages. And therefore, there is some calculations perhaps to be made to determine whether more compensation should be paid, as that might perhaps result in somewhat less tax than under the net investment income regime. So again, trusts need to distribute their income. Multiple entities should be considered being used to try to reduce the impact of this. I think if a trust has like $1 million of income, they're going to be subject to like a $55,000 net investment income tax. But if they divide it into the 1 million among two trusts, they can reduce the net investment income tax by almost 50% or something like that. So there's calculations to be made there, but the net investment income tax is going to become a much bigger issue in general, including for taxpayers with international income. And then next slide is dealing with another very significant, maybe the biggest revenue raiser, theoretically. The IRS is getting almost $80 billion in funding over the next 10 years, 45 billion of which is going for enforcement. And supposedly, according to the CBO, they estimate that the $80 billion will result in $200 billion of additional revenue over the next 10 years, based on studies claiming that for every $1 spent on IRS enforcement activity, the result, they get $5 to $9 of increased revenue. Interestingly, in the legislation, it actually says that none of this 80 billion that's going to improve the IRS is to result in any increase in taxes on taxpayers with adjusted gross income of less than 400,000. I sort of have to laugh at that. We'll see what happens. The legislation also mandates that the IRS commissioner provide to Congress a plan as to how the funds are going to be spent and make quarterly reports over the next 10 years. There is also a provision there doing away with section 6751B, which is the provision that requires IRS agents to get a supervisor's approval to impose assessed penalties. Most penalties are subject to that rule. And they want to eliminate that. The reason for the rule was to prevent revenue agents using the penalties as a bargaining chip in negotiations to agree to paying taxes in an audit, but they're wanting to do away with that. Apparently it'll save $1.4 billion because it'll eliminate quite a bit of litigation that's arisen because taxpayers claim that the IRS did not follow that statute. And finally, I mentioned in the last bullet point there that all this money will obviously increase the IRS's ability to enforce its over 50 international tax campaigns. And if you go to the website there, you can see all of their campaigns, and I'm sure one or more or many of them would be relevant to your clients. And while the international area has not received that much attention, it has over until maybe the last 10 years, starting, I guess, with the FIBAR issue when Union Bank of Switzerland was caught. It has become extremely hot in the international tax field. The audits and the penalties that are being imposed for taxpayers who are not complying with international tax rules are dramatically increasing. So they will just continue to increase with the additional funding from the IRS.
All right, so I think with that, we're at time, but Bill, do you want to make any closing statements? I know you have some slides.
Yeah, I'm just going to briefly mention what they are. These
Yeah.
are summary slides. This one, slide 33 that you're looking at, just reminds you that there's a lot of different effective dates. Those could change. We put a couple of provisions here that we didn't talk about that are effective at date of enactment. So obviously watch those. The one is the change in the downward attribution. The other is the dividend received deduction for foreign dividends by domestic corporations, and also extraordinary dividends from subpart F. The next one just continues some of these effective dates, which we won't go through. We've talked about them. The slide after that, these are kind of the financial thresholds. I mean, the one we haven't talked about is the corporate AMT. That's 3-year average adjusted financial statement income of greater than 1 billion. So carefully go through your client list to see how many you have of those. If you have some, you're probably not on this webinar. The next one, is just a
What all this reminds me, Bill, is that of the joke that they should pass a law that Congress cannot pass a law changing the tax laws more than once in every 5 or 10 years.
Yeah. Tom, you have any closing comments on what impact?
No, I think Steve did a good job when he went through this sort of impacts on individuals. That's really the private client planning, specifically the trust and estate, those thresholds, to the extent NINGs even work, they're not going to be as attractive because you're now adding another 8%. So I think Steve did a good job of summarizing them. So I think we can close with that. Our bios are in the back, as well as our contact information. If anybody has any questions, comments, concerns, feel free to reach out to any of us.
Okay, thank you for this great job. Really appreciate it. Very informative webinar. Thank you everyone for attending. If you're interested in getting more involved or active in the tax section, please reach out to me. We'll be having our monthly meeting tomorrow morning at 8:30 on Zoom. So if you are interested in joining us, please let me know and I'll make sure that you get the link, and have a great day. Take care, everybody. Bye-bye.
Bye.